In Chapter 10, we're going to learn about the cost of capital. And so the major objectives for this chapter is for you to be able to explain why the weighted average cost of capital is used in capital budgeting, for you to be able to estimate the costs of different capital components, and those are debt, preferred stock, retained earnings, and common stock, and then for you to be able to combine the different component costs to determine the firm's weighted average cost of capital. So the sources of capital that firms use are debt, preferred stock, and common equity. Now, debt is made up of short-term debt, like notes payable, and long-term debt, like when you think of a 20-year or 30-year bond. And then preferred stock is just preferred stock, it's simple. But then common equity could be considered retained earnings or issuing new common stock. So whenever we estimate the cost for debt, it's pretty easy. We use, well, pretty much one method. Preferred stock is easy, but then common stock, we have two different choices. And this depends on if the company is going to rely on retained earnings, then we use the cost of retained earnings. Or if the company is going to issue new common stock because its capital budget is greater than what the kind of cash that they have is, then they'll have to go out and issue new common stock, and then you'll have to use the cost of new common stock. When you take the weighted average cost of all of these components, you get the weighted average cost of capital. So the weighted average cost of capital is used primarily for making long-term capital investment decisions, for capital budgeting pretty much. So the weighted average cost of capital should include the types of capital used to pay for long-term assets. And this is typically what we've seen here: interest-bearing debt, preferred stock if they use it, and common stock. Keep in mind that spontaneous non-interest-bearing liabilities such as accounts payable and accrued liabilities are not included in the cost of capital estimate because these funds are netted out when determining investment needs. That is, net operating rather than gross operating working capital is included in capital expenditures. And so what we do to calculate the weighted average cost of capital, and the whole point of this PowerPoint presentation, is that we take the weight of debt times the rate on debt times 1 minus the tax rate, plus the weight of preferred stock times the rate, plus the weight of common stock times the rate. So it's really just a weighted average, and then we're going to look at how to estimate each of these component costs, like the rate of debt, the rate for preferred stock, and the rate for common equity. And so the first question is, should our analysis focus on before tax or after tax costs? Well, stockholders are concerned mostly with the corporate cash flows that are available for their use, which are those cash flows available to pay dividends or to reinvest. Since dividends are paid from and reinvestment is made with after-tax dollars, all cash flow and rate of return calculations should be done on an after-tax basis. This really only affects the cost of debt. Another question is, should we include historical costs or new, or otherwise known as marginal costs? In financial management, the cost of capital is used primarily to make decisions that involve raising new capital. So the relevant component costs are today's marginal costs rather than any type of historical cost. And then, how are the weights determined? Well, the best way to determine the weights, which these weights have to sum up to be 100%, is to get the target capital structure for the firm, and that's determined by management. So if they said 50% debt, 10% preferred stock, and 40% common stock, that would be the target capital structure. Now, if you don't have that target capital structure information, your next best bet would to be the market value weights. So you just have to look at their balance sheet and calculate what percentage is debt based on the market value. Well, you'd have to calculate the market values for debt, preferred stock, and common stock, add them up, and find the percentage that each one represents. And then the third and the least best choice is to go with the accounting book value percentages. So how much is if you look at a balance sheet, the book value of debt, book value of preferred stock, and book value of common equity. So again, the best would be to have the target capital structure weights. The second best would be to use the market value weights, and the third best would be to use the book value weights.